Hi, I'm Tom Kimner from SAS, work in the Risk Management Department. I'm here today with Chris Finger from the Federal Reserve Board, who works in the Banking Supervision Division there. What we're going to talk about today is TLAC, or the Total Capital Absorption Capacity that's come out. So, Chris, what are the top three things people should know about the structure and purpose of TLAC?
Okay, so I guess the first thing I would say is it's about resources. So there's an analogy we use a lot in resolution planning about living wills, and that's sort of the informal way we talk about a resolution plan. Continuing that analogy, I like to sort of use a topic or a phrase from the funeral insurance marketing, which is don't leave your funeral expenses to your children. And that's sort of what we're trying to do as far as expenses for resolving an institution. So the idea is that there are resources available if an institution is to enter into resolution, resources available to recapitalize, to absorb losses of the ongoing operations, to make sure that critical services continue to function, and to make sure that the institution is still viewed as a viable counterparty by the marketplace. So really about resources. I guess the second thing I would throw in is that resources are more than capital. Capital is really what we think of as a going concern, loss absorption, right? So it's as the institution is still functioning, still operating, capital is there to absorb losses that might occur at that point. TLAC, the intent is to be something on top of capital that's there when the institution needs to be resolved. So it's the gone concern piece of it. So when we talk about TLAC as total loss absorbing capacity, it's capital plus some amount of debt that is eligible to be bailed in or to be converted into capital or into equity in sort of whatever the institution is that emerges.
Okay, and so my understanding is that TLAC applies to the top banks internationally, or about the top 29 banks on a global basis. Do we think that this absorbing capacity should be broadened out to more banks? Do you think there might be future plans to expand the breadth of this type of absorbing capacity?
Right, so you're right, it applies sort of to a limited set of banks. It's to those that have been identified as globally systemically important banks by the Financial Stability Board. So we have 30 of those worldwide. Right now the proposal is to, for the time being, exempt a handful of those. But so we're roughly in the high 20s of globally important banks to which this applied because they've been identified as systemically important. So I think your question about, should it apply more broadly comes to the question, are there other institutions that are systemically important in their own right? And so another level of that might be what is referred to as DSIBs, or domestically systemically important banks. So those that maybe at a global level haven't been identified as potentially causing repercussions globally, but in a particular market were they to fail, that it would have repercussions locally that are very important. So we do have jurisdictions that are thinking about applying the FSB standards or a similar set of standards to those institutions that they have identified as their DSIBs. So we might see sort of as a knock-on of the sort of the TLAC regime of individual other jurisdictions applying this for their domestically systemically important banks.
Thanks. And one last question I've got is, when we think about this this new TLAC regulation, it's really there to address the too big to fail, which came out, sort of in the crisis, especially in the 2000s, 7, 8, 9. Do we think that this goes far enough to prevent banks that are globally important from future failure, from being a future tax burden to just citizens around the globe? So do we think it's deep enough? Do we think it's broad enough to really hit that too big to fail consequence?
Right. So I guess one important point on the too big to fail is that what we're trying to address is the perception that these institutions can't fail. So part of setting up a resolution regime is setting up a framework wherein if an institution does need to fail, does need to be resolved, that can be done in an orderly way such that critical functions still operate, such that we don't have a systemic knock-on, et cetera. So part of it is coming up with the buffer there. Part of too big to fail is having the plans, which is the institution's own plans, which are the authorities at the national levels for actually resolving the institutions, and where TLAC fits in is in terms of resources. So we're an institution to be resolved. Are there resources there that come from the institution and its investors, so debt holders, equity holders, et cetera, that they take the burden rather than the taxpayer? So it's about facilitating an orderly resolution in such a way that the burden of that is not necessarily coming from the taxpayer or the public at large, but from the folks that have invested and sort of knowingly taken on the risk that this might be something that happens.
Great. Well, there you have it. TLAC in a nutshell. I want to thank Chris Finger for his participation. And I'm Tom Kimner from SAS. Thank you very much.